Midas VWAP presentation by the private banker. Warning: reproduction and sharing of this content is strictly prohibited. All information in this presentation is for educational use only and is not investment advice. There is a substantial risk of loss in trading commodity futures, stock options and foreign exchange products. Past performance is not indicative of future results. In this presentation, I will discuss Midas VWAPs and how to apply this tool to your trading thesis. I will be covering the topics: what is a Midas VWAP, how to anchor a Midas VWAP, adapting to change, from macro to micro perspective, an intraday inventory and application. There is a great book provided by Bloomberg, Midas Technical Analysis, a VWAP approach to trading and investing in today's markets. Even though the application will not be the same as provided in this book, it is similar and will give you a greater understanding to the application of Midas VWAPs and VWAPs as a whole. What is a Midas VWAP? So before I go into Midas VWAPs and how we apply them to today's markets, I'm going to cover the basics of what VWAP is as a primary factor. This is a distribution bell curve. As you can see, the 100 is the mean, which is what we consider VWAP. So any mathematical VWAP calculation finds the mean, and from the mean you can then calculate standards of deviation away from the mean. And this is just a visual, typical symmetrical distribution bell curve. So what is VWAP? So here is a slide from a Goldman Sachs presentation from 2003, I believe, just touching base on the basics of VWAP. So VWAP is volume weighted average price. So VWAP equals trade price over quantity divided by quantity. So for an example, for free stock trades, so if you executed 100 shares at $100, 200 shares at $100.50, and 300 shares at $101, VWAP of your trade would be $100.67, which would be the mean price of your trade. Here is a second slide from Goldman Sachs around optimal execution, so execution risk. So this would be the market open, and this is going to be the mean, and this is going to be standards of deviation away from the mean. So this is two standards of deviation in this example, and this is time to execute. So when you have a large order to execute, here's the predictable executions, and this is slow, highly uncertain executions. So by filtering through a large order through the day time frame, through the whole day, you can make sure that you get an average execution price rather than a bad skew on the day regards unpredictable price movement. And execution risk is the cost of delayed execution in terms of possible stock price movement. So here's just a more in-depth calculation for VWAP. Obviously we don't have to understand completely the VWAP calculation, as this is mathematically done for us through the computers nowadays. But it's good to see the actual equation and understand the actual factors behind this equation. So here is the VWAP calculation. So VWAP, number of shares bought times share price over total shares bought, and that is VWAP. Obviously getting into it a bit more in depth, here are the parameters for the equation and the meaning of it if you do wish to investigate into this further. But as you can see, the VWAP is this line here, and this is the mean. So from when this market opened, from when it started to trade, it starts to calculate the mean price off of the open through the trades that come through the market. And as you can see here, the blue area is the first standard deviation, which we consider a value. And then what I have here is the 1.5 standard deviation. This is just a very visual way to plot the calculation to help us visualize the markets through the day. But as I said, in the distribution bell curve, on the finished trading day, this would be the mean, the first standard deviation, and then the 1.5. Obviously, if we were to look at this as a distribution bell curve, as I showed you before, then we could obviously add more standard deviation. But for visual purposes, I normally just plot the first standard of deviation, which we consider value, the mean, and then the 1.5. So what is a Midas VWAP? So a Midas VWAP is an anchored VWAP calculation from a certain point in the market. Normally this would be around major fractals in the market, which I'll go into more detail shortly. But as you can see here, this is a Midas VWAP from the high that's been running, showing inventory running from the high. So typically with the VWAP application time filters that we use a yearly, a quarterly, a monthly, a weekly, and a daily. And this is how we use to structurally split out the times in the market to give us a filter process. So what is the point in a Midas VWAP, you may ask? So with algorithmic trading these days, I'm just going to explain how a Midas VWAP can help you determine balance, imbalance in the market, and as an additional tool to your trading. So this is a crude oil macro time frame. And as you can see here, we've anchored the VWAP from the high of a high fractal in the market. So in this example, we've seen the market make a high, a lower high, a lower low, a lower high, and then the market has broke down in a new trend with change in the market. So what we have done here is we've anchored the Midas VWAP from when a seller started to enter the market. So when a seller starts to enter the market and starts to build a short position with short inventory in the market, this seller, institution, hedge fund, investment bank, whoever they may be, will start to track their position through VWAP and how they execute their orders. And obviously with algorithmic trading programs in the market, this is how the computer and algorithm starts to execute their order and continues to execute their order until the whole order has been executed. So as you can see here, we started to see balance, and then the market started to become imbalanced, and then we start to reference the 1.5, the one standard deviation. And as soon as the market starts to become imbalanced here, you can see how the algorithms start executing off the 1.5 standard deviation. We see this pop back up to the first standard deviation where more selling starts to enter the market. Once they finish this selling and the selling overwhelms the buy-in, the market becomes imbalanced again, and they start to reference the 1.5 standard deviation all the way down here. We start to see some two-way trade and break the 1.5 standard deviation with a last push down, and then we finally see the change where the inventory short is done, and we break back into value, and then they see a reversion to the mean. As soon as we head back to the mean of this current inventory in the market, we see more sellers piling back on to the 1.5, and then finally a two-way trade comes back into the market, and we see a reversion to the mean and the other side of value. The point being here is you can see how algorithmic trading and how traders perceive the perception of value and price from this key fractal point, and how traders and the market starts to behave around this inventory VWAP in the market. So again, once we see this change and we see the short-term inventory enter the market here, we can then see the long inventory entering the market, and you can start to see how this inventory starts to play out. And as you can see here, we start to anchor from the fractal low, and you can see how the market becomes imbalanced. We start to reference the top of value. We see continued imbalance. Then once this inventory is over and this correction has happened, you can see the market comes back into value. We see a reversion to the mean. And again, you can see how these multiple VWAPs of inventory start to play out now over time as buyers and sellers, short-term inventory, short inventory and long inventory enter the market, and how they view their perception of price and how they are tracking the inventory in the market. And as you can see here, I've highlighted the changes of when the imbalance is over from that inventory. So we see the change here. As soon as we see this change, we start to see two-way trade come back into the market. And again, once this buying imbalance was over and we broke the 1.5, the one standard deviation, when we see a reversion to the mean, that's when change is happening in the market. So how to correctly anchor a Midas VWAP? So there are two ways that you can anchor a Midas VWAP. The first example I'm going to use is anchoring the Midas VWAP from a key fractal low. The point being here is either sellers have exhausted themselves in this situation and buyers have started to step into the market, and so once this aggressive buyer starts to step into the market and defend his position, their position, we see a change. So this is a key fractal low. Obviously, if we put in a lower low here, then this would be an invalid fractal. But in this point, we held this valid fractal low, and we can start to track the long inventory coming into the market from this key area. And as you can see here, we see the buyers come in, we see more buying come in, and we see an imbalance starting to happen from a macro perspective. The market comes back, it references the developing value area low of this inventory, and we see more buying stepping in. Once the market sees more buying stepping in, we pull back to the mean, where the algorithms start to execute now off of the mean price. And you can see how the market starts to become imbalanced. And the market starts to execute off of this Midas VWAP from this key fractal low. It's very, very visual. You can see this. You can see the orders sitting here. We can see these sellers coming down, and we can see price executing off of the mean. And then finally, we see this final blast up with a real imbalance occurring in the market. And then once the market become imbalanced and we start to see this imbalance occur, then the market starts, the algorithms and HFTs and the traders start to execute off of the first standard deviation, which is the top of value. So once the market has stopped executing off of the mean and showing an imbalance, the market then will start to execute off the next best price, which happens to be the developing value area high here. And you can see that the market almost channels now between the 1.5 standard deviation and the 1 standard deviation, which is a value higher. And when we continue to see this, the buying occurring off of the best prices in this time. The second way to anchor a VWAP is off of the first pullback in a trend. The idea being is the market tops out at the bottom. We see the sellers try to push it down, and we finally see a buyer coming in and aggressively defending this low and committing long inventory in the market. And as you can see, very, very similar sort of visual here, where we see buyers stepping in a value, the market starts to become imbalanced, we see execution off of the mean prices, and then finally we see this imbalance as we start to break that 1.5 standard deviation and we start to reference the value area higher. So very, very similar. It just depends on how you interpret things and how you like to do things. There's no right or wrong way. The first pullback in the trend or the key fractal low are both good ways to anchor a Midas VWAP. Just as an example here, over a longer time frame, I've anchored them from both points here, and you can see that over time they pretty much catch up with each other, and they become the same as each other. And you'll see this as well with the time filters and the Midas VWAPs on the day, which I will show you shortly. But this is just both overlaid, and you can see how the market reacts and how the average price averages out to pretty much the same as each other. But they are the two typical examples on how to anchor a Midas VWAP from the first pullback in a trend or from the key fractal low. So this is just a quick example of a market from a macro perspective of key places that you can anchor Midas VWAPs, being highs and lows in the market. Obviously you could have probably used this fractal high here, but you can see how short term this inventory was in this correction, and I probably wouldn't have used that. I mean, you could have referenced it in real time, but as it broke back into value, then you could have just you could not stop tracking this inventory. But as you can see, these are key fractals where you would be placing Midas VWAPs to track that inventory from the buyers and sellers entering the market with short-term inventory. So this is just another example of anchoring the meters VWAPs and how they play out. So from the high, we can see the imbalance. We broke back in, we came back in and referenced the mean. We see sellers enter back into the market where we see a further imbalance, and then we finally see this key fractal low. So now we've entered a VWAP from this fractal low. And as you can see, we see imbalance occur and we come back in for two-way trade. Again, this is the key next fractal low, and as you can see, imbalance, 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 pretty much up to that 1.5 standard deviation of that previous anchored VWAP that was in play. And then we see two-way trade come back into the market. And then we use the next fractal VWAP, and you can see this one didn't work out as good example as the rest of them did with the imbalances. But as you can see, the market become imbalanced. We came back and referenced the meters VWAP, and then we start to see the imbalance occur back to the meters VWAP, and then we come back to the low of this previous meters VWAP here. So you can see how the short term, long term, and different trades come into the market with these different VWAPs and how they all play around each other. But at the end of the day, I mean, what happens eventually is they all start to average out and come together. So you really want to be paying attention to the aggressive meters VWAPs. I mean, once this come back into balance two-way trade, you can start to track the new inventory. Once the first standard deviation is broken and we start to come back to the mean, then sometimes there's no real point in tracking that inventory unless it's over a longer time frame from a key fractal area. So adapting to change in inventory is what I'll be covering next. So as we can see here on this example, I've used the first key fractal low in this market. And as you can see, as the market starts to become imbalanced, the market starts to execute off of that first standard deviation, the top of value. And we see the market rejecting value the whole way up as we see imbalance in the market. Once the imbalance is over, the market breaks back in to value, showing two-way trade in the market. So if you manage to establish a position here and you start to buy the top of value and establish a position long in the imbalance that you've speculated, once the market comes back into balance and you see change and you see the market stop to execute off that 1.5, that one standard deviation, there is no edge staying long in the market anymore. And this is the point being, which I was trying to example earlier, of once the imbalance is over, we see a break back into value and there is no edge being long. And this is the main change that we see in the market. Once we see the market come back to the mean, there's no reason to stay long, and this is the change that you're looking for to exit your positions. The reason being is this algorithm, this market, this imbalance is over, and the imbalance is over is because there's no demand at that first standard deviation anymore. When there is an imbalance in the market, the best price the market can execute at is that one standard deviation. And when the market becomes very imbalanced, it executes off the 1.5 standard deviation in rare cases like this. But as you can see, as soon as the market comes back into balance, change comes into the market and we see a reversion to the mean and then the other side of value. And in this case, we went from the 1.5 plus standard deviation to the minus 1.5 standard deviation. So from one side of the bell curve to the other. But again, if you didn't recognize the change in this situation and then exit your position on the break of this value, you would have given back most of your profits on that trade. And as I said, there was no edge staying long, so this was the change in perception of price and value. Again, as a further example, so we see a short-term imbalance to the sell side. The market starts to reference value and the 1.5 standard deviation. As soon as the imbalance is over and the selling execution is over, the market will return back into value and we see a reversion to the mean. So again, once you see this start to come back into value here, there is no edge staying long, and you're best exiting any short positions in the market. So from a macro to micro perspective, as an additional tool for your trade analysis. So this is crude oil from 2008 to present on the back adjusted contract. And as you can see here, from that high in 2008, we see a huge imbalance to the sell side. Once the imbalance was over, we broke back in to value, and we see a reversion to the mean. So you can see how powerful this works across multiple time frames, from macro to micro to intraday to weekly, monthly, yearly. It doesn't matter. The application is the same, balance to imbalance. When the market is imbalanced, we execute off the 1 and the 1.5 standard deviation. Once that imbalance is over, whether it's to the buy or sell side, as soon as we come back into value and we enter the first standard deviation, it's showing a change in perception of value price. Normally the imbalance in whatever side the market is trading is over, and we are likely to see a reversion to the mean here. For sakes of educational purposes, obviously you can see how this long-term inventory plays out. So as soon as we came back in and we show two-way trade in the market, we see a reversion to the mean. Then we see a reversion. Then we see the market auction down to the value area low, where we see buyers step in, and we see a reversion to the mean and an auction to the value area high. And from there, we just see two-way trade and rotations. But you can see how well the market executes around this longer-term inventory in the market. So, how does this help you? So, from a macro to micro perspective, you can see longer term trends, you can see longer term imbalances and longer term inventory in the market. So in this perspective of crude oil, what this is telling you is the market is in two-way trade and is very balanced at the moment. Obviously this is a very higher time frame perspective, but this is just tools to help you generate a general thesis over the whole market environment, going from top down, from the highest time frame to the lowest time frame. Again, this is from the bottom that played out from the sell-off in 2008. So once that inventory was over and the imbalance was over, then we can use the inventory from the buy side. So again, I've just highlighted some key areas that you can look at some fractals to place some meters VWAPs to monitor that inventory from them prices. But again, as you can see, as the market becomes balanced, we've literally just seen two-way trade, reversions to the mean. And once the market becomes overextended, it sees a reversion back to the mean and then plays out to the other side. Again, how does this help you on the intraday time frame? It doesn't, but this helps you to generate a general thesis from the whole over-term context of the market. You can see how well the market does reference this on the higher time frames, with execution off of the VWAP levels from this key inventory. As the market obviously over time becomes more balanced, we can see how much better the inventory holds and respects these levels. And as you can see, as we come to the end of this VWAP, how well the market respects these levels with regards to the 1.5 and the mean to the 1.5. So this is a macro to micro perspective on the S&P. So this is the S&P daily. And as you can see, I've started to anchor a meters VWAP from these key fractal low areas. It's down to you which one you choose, but at the end of the day, once this starts to pan out, you pretty much get the same meters average on the chart. But as you can see, as the market starts to come in balance, it started to execute off that 1.5 standard deviation. There was a small retracement back into value here, but as you can see, the market started to execute off the top of value, and we start to see a channel in between that first and 1.5 standard deviation, all the way up until we see change. Once we see the change happen, we see a reversion to the mean. So any longs in the market here, you're best exiting once we see this change in inventory. Once this happens, you can start to look at the next inventory, which is now to the short side. And you can see how it plays out again. You see the imbalance in the market, imbalance. On this case, we see a reversion to the mean. We see aggressive sellers enter the market. And then on the pullback to value, we see aggressive selling. And as you can see, the market comes very, very imbalanced here, and we start to execute off that 1.5 standard deviation. As soon as we find the bottom and buyers come back into the market, again, any shorts in the market, it's best to exit the market here because we can see change in the market. And then we get to establish the next position. And this has been that current inventory for the last year or 2 years on the S&P. As we found a bottom, we started to auction higher in this very bullish trend that we have been in recently. And you can see here how well the market references this VWAP here. Every time we came back to this VWAP, we see execution, we see imbalance. And the market becomes so imbalanced here that we would have started to reference this new inventory here, because There was a breakout here, and you can see that the aggressive buying that came into the market. Obviously, this is very discretionary, and there is no right or wrong way of doing this. I'm just giving you examples of how to use this tool to look at short and long-term inventory in the market to give you an additional edge in context regards change. So here is a current example of crude oil. We are currently in October now, and I just thought I would use this example as a recent example for crude oil. So obviously we put a top in crude oil about $107 a barrel, and we broke out to forming this trend to the downside. So in this example, I've chosen this bar to run the meters VWAP off. We could have run it off the top bar, this bar. It didn't matter. They all pretty much line up the same, but in this example, I've used this bar to run this inventory from. And as you can see, the imbalance occur. We see a reversion to the mean. We see a brief pause in the market, and the market starts to become imbalanced again. So the best way to approach this would have been, if for a long-term swing, would be to start to run a short position. Once we see this break back into value, then you could exit and wait for further information. Once the market started to reference VWAP and we started to see this balance come into the market, as soon as we broke out of that balance, then you could re-establish a short position with stops inside value. And as you can see, since then, the market has seen a very big imbalance to the sell side, and we've trended all the way down for a few months now. For 4 months, I believe we've trended down in crude oil. And the market started to reference this 1.5 standard deviation. But the point being is, you can see how well the market represents and rejects value. We started to see this two-way trade come back in, and then the market almost broke back into value for a mean reversion here, and you can see how aggressive sellers entered the market, pushing this back out of value here now. I just thought this would be a great example to run for the current market conditions in crude oil with this trend down this year off of the highs. And we are currently still in a bearish trend, and we're still out of balance to the sell side. This is a very macro perspective, but obviously, like I said, this helps generate a trade thesis for you from macro to micro to help you better understand what the market is trying to do. Now I'm going to explain how to use intraday meters VWAPs applications, which is probably going to help you for your intraday trading. So this is an intraday example of crude oil. As you can see here, again, same example from macro to micro. The market starts, we see a change in the market, we see a key fractal low, and we see buyers enter the market. We see an imbalance occur to the buy side. The market sees a very strong buying imbalance, so strong that the market starts to execute off the 1.5 standard deviation. Once this order has been filled and the market has finished executing to the buy side, we see two-way trade start to come back into the market. The first clue would have been the break of the 1.5 standard deviation. We came back in, value caught up at price, and we see this attempt to break out. Once we couldn't break out and the market entered back into value here, there was no edge staying long, and you exit any core positions. And as you can see, as soon as the market came back into value here, we see a mean reversion and a destination trade to the other side of value. So you can see how powerful this can work with imbalances in the market. When the imbalance is over and that HFT algorithm, investment bank, hedge fund, whoever it is in the market, along with other traders executing off of this meters VWAP, once this imbalance is over, we see the change, and there is no edge staying in the market anymore in that direction. Similar example again, just buying, rejecting the 1.5 and the 1 standard deviation the whole way up. We see this break of the 1.5 after a nice big imbalance of buying here. We see volume start to come in, and the market enters the value, the 1 standard deviation. Once this happens, again, reversion to the mean. So again, the principle in this is, once we see these imbalances occur and we start to execute and trade with these imbalances, once we see the change where the market breaks back into value and shows balanced two-way trade, there is no edge staying long in the market. And you can see, again, through multiple examples I've shown in this presentation, once we break that 1 standard deviation, the likeliness is a reversion to the mean. It's just the way the market auctions. So we see the imbalance occur, we see two-way trade come back into the market. So the market auctions down to the mean price, auctions to the high price, auctions to the low price. It's just generally how the auctions play out. And this is why we see pullbacks in the market in a trend, and this is why VWAP is so powerful, because we can use this for very precise executions levels for your trading and for identifying key changes in the market. Just an example now to the sell side. So we see a selling imbalance occur, we see sellers step in, we use the key fractal high, and then the market becomes imbalanced. We break out of this balance, this two-way trade area here, and you can see the market starts aggressively executing off this 1.5 and 1 first standard deviation, all the way down until finally we find a buyer. Once we find the buyer and the selling imbalance is over, we break back into that first standard deviation and we see a reversion back to the mean. Again, key context. We have seen change in the market and there is no edge staying long or short. In this example, there was no edge staying short. And if you didn't catch the short, then you could always look for the reversion to the mean and a destination trade to the other side. But as you can see here, you can see the selling imbalance. You can see how the auction process works. We see selling imbalance, we see reversion to the mean, a test of the developing value area high, we see more business being done at VWAP, we see auction to the developing value area low, buyers step back in and the market starts to become imbalanced again. The market becomes imbalanced, we start seeing execution off the 1.5 standard deviation, we finally break back into value for a mean reversion. This is just examples of how the auction process works and how the market trades around these meters VWAPs. Here's just another example. So on this day here, you can see that we see buyers step into the market. We just see two-way trade off the open. We see buyers step into the market. We finally find a key fractal area. We see two-way trade come back in. We can start to track this selling inventory. If we obviously put a new higher in here and we broke through this first standard deviation of 1.5, then this meters VWAP would have been invalid and we wouldn't have been able to use or execute off of it. But as you can see, once this imbalance started to happen, we started to execute off the first standard deviation and the 1.5. Again, you can see how this channel comes into play, where the market executes off the first and the 1.5, and we see, as I said, this channel in between the first and the 1.5 all the way down. A little bit iffy here. You could have faked you out with a break back in, but a good way sometimes to trail this is off that half standard deviation inside, which is not plotted here, or you use the general context of the market. But either so, you would have caught a majority of this trade even if you did exit this core position here. But as you can see, the market came back in. We see aggressive selling back out of the market. We see this final push down to this big cluster of buying volume that you can see here, and then the market enters back in, and you see change. So if you did exit your core position here or here, I mean they're pretty similar prices anyway. So regardless of you not being able to catch this whole move, you can see the powerfulness of how these meters VWAPs work. And you can see as soon as we come back into value here, we see reversion to the mean and almost to the other side. So the market is approaching trade location. Start seeing the buyers coming into the market, absorbing the sellers here. So start to run a meters VWAP from the low. This will be where your entry is here. So now you'll be long from 92. 32 with stops back inside the previous value. Obviously what we want to see now is the market not making a lower low, and we want to see responsive buying back into the day's developing value here. And as you can see, the algorithms are starting to execute off of the meters VWAP. So finally we see a buyer step in, we see an imbalance start to occur, we see the price push back into the developing value on the day, Now we want to see the algorithm starting to execute off the top of the developing value of this meters VWAP I've just anchored on the chart. So now we've seen the pullback to the developing value area high on the meters VWAP, and we're going to start seeing if the algorithms start execute off the top of the developing value here. Okay, so we've seen a push down to the meters VWAP and into the developing value area low for the day, and we've seen responsive buying again off of the mean of the meters VWAP, with confidence with the day's developing value area low here. So by now you should have had some scales out, and you should be managing a core position from your established trade location. If we start to break through the developing value area low on the day now, and we start to break through the mean of the meters VWAP, then this trade is invalid, and it's a heads up to get out before you take a full stop. As you can see from these wicks, the algorithms are starting to execute off the top of the developing value here, and we want to see an imbalance start to develop now. Again, a pullback to the top of the developing value area higher. We're seeing buyers starting to come in. There's finally more buying. Now the meters VWAP is starting to see an imbalance. We want to see algorithms starting to execute off the top of the developing value. You should have had more scales into the mean of the day. And obviously we've seen a push up here now to that previous highs, so we want to see responsive buying out of the highs for continuation. And if we start to break back into the developing value area high on the meters VWAP, and we start to break the mean of the meters VWAP, then again it's probably a heads up that this trade might be over. It might be worth getting out of the position. So we're just seeing some liquidity coming in on the day's mean prices here. You can see that the developing value on the meters VWAP is catching up with price here. So again, we want to see algorithms executing off the top of this developing value. Confluence with the day's mean. So again, we're seeing price catch up, value catch up with price, and we're seeing buyers entering the market, and the meters VWAP is showing imbalance to the buy side now. So this could be your final target as a destination trade. Obviously we're pushing an outside day now, so you could look for further imbalance to the buy side, and you could exit the position on any break back into the developing value area high on the meters VWAP. You can see that the algorithms is now starting to try and execute off the 1.5 of the meters VWAP here. We just broke that, and we're just pushing back down to the developing value area high. So again, if you've not had your final target filled, then you'll be looking to exit your core position on this trade once the market breaks back into this meters VWAP developing value area high. Price value still catching up with price on this meters VWAP from this anchor point. It's coming back and testing that previous high of day now. So this is where you'll be looking for either a flush back in, and or algorithms and the HFT is still executing off the top of the value here. Okay, so we're still seeing some buying off the top of value, and we're still not seeing a clean break back in. So at this point here, you can start managing your position and either putting a stop below the mean for the day, or you could start just putting a tight stop below this area in case we see a break flush back into the meters here. Okay, so now it's the heads up that the imbalance is over for this trade now, and you should have exited your core position now. Okay, so we're seeing a potential another setup here. I mean, the market is still showing two-way trade balance on the day. Obviously, we see a gap open on this day. We've seen a reversion back down to value. We've seen two-way trade back in the market now. So what we want to see is push back up to the 1.5 standard deviation, and then we put stops above the high of the day. If we are going to see a further imbalance and rejection on the day, then the market will break out above this 93.46, and we'll see a potential imbalance created on the day here. But at the moment we're still looking rotational, so we're going to see what happens at this 1.5 standard deviation. So you'll be putting a sell limit at 93.30 here, with stops above the RTH highs, expecting continued two-way trade. So you wouldn't have been filled yet. You'd still be waiting to see this market here. I mean, if you don't get filled at the 1.5 standard deviation and we see the sellers come in, then you try to sell the bounce back up to the developing value area high with stops above the 1.5 standard deviation and the high of day on the pit session. So you can see the battle here with the buyers and sellers in the market with two-way trade here. There's no clear imbalance at the moment. Even though the path of least resistance is to the buy side, we are seeing sellers enter the market here. Okay, so you would have moved your, no, you would have kept your order at the same place. Okay, so now you would have been filled short, and what you want to do is see this high hold now. I mean, if we see buying into the 1.5 standard deviation here, and we come up and test the highs, then you're wrong and you get stopped out. Okay, so now we're starting to see sellers enter the market, so we can start to run a Midas VWAP from this high now. We want to see algorithmic trading, and we want to see what happens here with this inventory coming into the market now. So again, you want to put your stop above the high of day now. So you probably have your stop at 50, if not 60, to give this a bit of room to breathe. And what you want to see is, obviously, you don't want to see the market start breaking that 1.5 standard deviation now, otherwise you'll be wrong. So we're still seeing a bit of a battle here. We're seeing buyers and sellers two-way trade in the market, but the sellers are present, as you can see, and we are starting to see execution off this Midas VWAP. So what we want to see now is we want to see a push back into value, and we want to see an imbalance start on the Midas VWAP that we've tracked from that anchor high now. So your first scale is going to be into this globe, into that previous high, and so your first scale is going to be around 95, if not you can put it a couple ticks above the Globex VWAP, above the RTH VWAP, sorry. So now there's a potential for your scales, and as you can see there's an imbalance on this Midas VWAP now. So what we will look for is we will trail your stop just above VWAP, or you can take an exit as we break back into the Midas VWAP, showing that the imbalance is over to the sell side on this from this fractal high. We're starting to see some liquidity come in at this VWAP mean on the day. And what we don't want to see is, like I said, we don't want to see this break back in and break above the Midas VWAP mean at the minute. It's still quite early, so we have to see what happens here. Sellers are trying to now lock price back into that previous day's range. Again, we're seeing selling off the developing value area low of this Midas VWAP now from this running inventory. Obviously, if the buyers are here at the mean of this of the day, then we're going to break back in, and it might be a heads up to get out of this trade. Still seeing two-way trade at this mean price. Trying to push back in now. So again, best place on this, as it's quite early, would be to trail your stop above the mean of the Midas VWAP here, but ideally we don't want to see it break back in here now. We want to see aggressive selling to the sell side. The value has caught up with price now from that fractal high, so again we want to see sellers pushing the market down here. Okay, so this is make or break for this trade now. We want to see execution, and we want to see selling off the mean of this Midas now. And as you can see, the market came back, tested it, and you can see the algorithm executing off of that mean price. So now we want to see a breakdown. If we don't see a breakdown here, we'll most likely come back up and break the Midas VWAP, and that will be a heads up just probably to get out of your trade. I mean, this is a rotational balanced two-way trade market, so I mean, obviously the theory behind these type of trades is obviously stop above the high, and we don't want to see any further upside on this market. But regards how to use these Midas VWAPs, this is the correct way to use them. So again, we're going to see a seller come in and commit, and we're going to see a further imbalance, and or we're going to see buyers off the day's mean, and we're going to break the Midas VWAP and head back to the developing value area high. Still seeing a battle at this previous high of day. It does look like buyers have entered the market here, so if we do break down, we're probably going to see them get stopped out, and we're going to see a further imbalance on this Midas VWAP. Okay, so value has caught up with price quite well here now on the anchored VWAP, so again we want to see a flush down here now. If not, this will most likely reverse back to the developer value area high and potentially break out of the higher day. You can see there is selling coming into the market here as the average is being pulled down into price at the minute. Okay, so there's the sell-in. There's going to be stops from any buyers that are coming in there that are weak, and we are starting to see further imbalance on this Midas VWAP now. So again, the idea will be, now that there is an imbalance in the market, we want to see some nice sell-in, and we want to see the algorithms executing off of this developing value area low. So here's the pullback to the developing value area low. So you're monitoring this for selling execution off of that area. And as you can see, sellers are here presently. Are they going to push the market down, or are we going to break back higher? Now, obviously, you should be scaling some more contracts off of your running core into the developing value area low on a day, and waiting for further information in regards to what we're going to do here now. So you should have a resting buy limit at 59.60. Okay, starting to execute off the 1.5 of this anchor VWAP now. Getting close to where your second scale should be. If not your final target, if you're looking for a destination trade, it just depends what you are looking to do here. Obviously we've come back in for an inside day now, so you could potentially be looking to target the developer value area high or the point of control VWAP from the previous day. Still, we see an execution off of the value area low here on this Midas VWAP. Heading towards your second scale here, if not your final target. Okay, so this should be your second scale, your final target filled in the trade now. If you are getting your second target filled and you still have a core running position, then what we want to see here is obviously a breakdown, and we don't want to see the market, obviously, like I said, trade back into the developing value area or above this mean price on this anchor VWAP. It depends on how you want to trail the stop, depending on the aggressiveness you're seeing in the market and the context on the day. Again, you can see how they're starting to try execute off the 1.5 here. Might pull back to the developing value area low, as we are right at the developing value area low for the day here now. But at the minute, we are currently imbalanced on this from this inventory from this high, and we are still seeing sellers come into the market here. Some two-way trade and targets getting filled, and potential buyers coming into the market off the developing value area low for the day. So again, if we do break back in here, then it probably just a heads up to get out of this trade from the area that we're in. Still seeing sellers trying to sell into the developing value area low, value catching up the price from this Midas VWAP. So what we want to see is a continued sell-in, and we want to see a spike down here. Okay, so there you go. Anybody who was buying there just got stopped out. They just got flushed out of the market. We're still seeing an imbalance on the Midas VWAP, so you're still running your core short if you're in a runner. So you can see how it's how they're lining up now. So the developing value area low on the Midas VWAP, and for the day now is acting as confluence. So, and again with this imbalance now and this range extension, we don't want to see the market break back in. And if the market does break back in, it's just a heads up to exit your call. So you could obviously be targeting the developing value area higher for the day, depending on the context, or you could just, obviously, like I said, just leave this run in until the market comes back into balance on this current inventory. You can see the targets and potential buyers coming into the market here. Sellers are still overwhelming the bid and bidding the market down back into that previous value. Still clear imbalance here. You could run the second Midas VWAP from here now and just see how this plays out, as you're looking for any excuse to get out of this market as an exit. For the sake of this though, I'm going to continue to run this off of this fractal higher. As you can see, they are executing off the 1.5 standard deviation now, as this imbalance is quite strong from this inventory, and we are trying to lock price back in. So now we're looking to target the mean from yesterday, or you could be looking for a destination trade all the way back to the lows. Just depends on what your plan is here. Okay, starting to break that 1.5 standard deviation here. See if there's any aggressive sellers here. Clearly see at this price level, this 92.05, there was some resting limits absorbing, so there was bias here. Okay, so now we've seen a pullback to the higher, we've seen a break of the 1.5 standard deviation, we're starting to reject that previous value area again. So here's just a clear area that you will be looking for. I mean, if we continue to break back into value here, then there's no reason to stay short here, and it's best to exit. So at the minute we have seen sellers trying to enter the market here, we are seeing sellers trying to execute off of this developing value area low, so we just have to monitor this. Okay, so we're starting to break back in now. Okay, so still seeing sellers. Just going to quickly check this this Midas here and see what's happened. So you can see we have come back in on this Midas. Again, I would probably just have anchored it from this fractal high, as it's more important. And you can see how the inventory was, how they were executing off of this. So again, just a battle here now. So your stop's going to be above this 92.32 level. If we break above this 92.32 level, then this trade's most probably done, and there's no reason to get out. You can see the market coming back here. So now you're stopped out. Okay, so this is just an example of how you can use these Midas VWAPs to trail your stops and your positions. And the reason being, the point is as you can see that once we see these imbalances over on these Midas VWAPs, then most of the time that's pretty much that move done, and most of the time that's how you catch the maximum profits on these moves, especially on crude oil. This works very, very well on crude oil. And you can see here, as soon as we broke back in and we see this strong buyer come back into the market, then the market's just seen two-way trade, and we've seen a reversion to the mean on this Midas VWAP. So obviously I understand how hard it is. It's touch and go, because there's a couple of times here that you could have looked to get in and out, and but obviously with experience and a lot of time and effort, then you understand how these tools work, and you use them to the best of your capability. Anyway, I hope them examples show you how I use this Midas VWAP tool, and how Ben has showed me to use this, and the most effective way to manage your positions around how the current inventory is coming into the market in real time. Because whoever was up here looking to sell, and they start to sell and establish a position short, I mean, this isn't one guy. I mean, this is most likely some big order that's coming into the market, and they can't just come in and hit the bid down with 2,000 contracts, because they will just crash the market and get a real bad skew on the position. So what they would do is use algorithmic trading, VWAP orders, TWAP orders, to come in and execute at the best price they can, to get the best average price they can for that trade. This is the end of the Midas VWAP presentation. It's quite a short presentation, but there's only so much I can go through in this tool, as the basics of it are balance, imbalance, and just looking for change in the market, and obviously correctly anchoring these VWAPs. Anyway, I hope you enjoyed this presentation, and if you have any questions, then please ask on the forum.